Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we're going to go over some technical analysis, some simple indicators, and ones that I like to use. You guys have been requesting this for a while, and so here we go. Alrighty, let's go to the charts. This one will be the S&P 500, and so let's start out. First one is price action. So each of these bars you see here is price action. And if we zoom in on any one of these bars, we can see that, like on this one right here, it starts, this left bar right here, starts at $5,866. And then this right bar right here is 59, we'll call that 59.30, okay, 5,930. What that means is the price opened the day, Wednesday, November 6th, at $5,866, and then ended the day, the very last bid was $59.30. And this bar in between going up and down is the price action that happened in between then. So it got even a little bit higher, and the same is true for here. On the left side, it opened right here, and then it closed right here. So it traded for 6.5 hours, and then afterwards it landed, started there, ended there. So that's price action. These are bars. You can also do candles if you want. I prefer the bars. They're a little bit easier for me to process, but either one works. Okay, so those are the bars. These down here are volume bars, columns. And so they tell you what the volume is, how many shares were traded that day. So if we hover over this one right here, the last one, and then we look up here to volume, VOL, it tells you how many shares were traded that day. 2.6 billion, then 2.67 billion, then 3 billion, 4.04 billion, right? So that tells you how many shares were traded in the S&P 500 every day. Then if I expand this right here, right down here, we have the RSI. And what that stands for is Relative Strength Index. And basically what you need to know on this is that when it gets kind of high up here around, 70 or above, that generally means that it's overbought. Too many people have bought it, and you're usually going to have a correction back down to the downside. And if we go back down here and we can hover over this RSI moment in time back here in August 5th, we can see that the RSI, if we look over right here at this purple number, we can see that the RSI is at 30.55, and check that out. That happened to coincide with the lowest point in the S&P 500 since then, and after that, it went up. Coincidence? I think not. So that's the RSI. Now, MACD, this one down below it here, stands for Moving Average Convergence Divergence, and basically, without getting too complicated into it, the way I understand it is when you use it in tandem with all these other indicators, right? So use it in tandem with the RSI and look at the RSI, and if it's low and you also have a lot of red bars down here on the MACD, then it's pretty oversold and it's probably time to buy. And then if it gets up here and it's getting into the blue and kind of in the green up here, then it's a little overbought and it's probably time for a correction. So if you're a trader, you could buy down here when the RSI is 30 and the MACD is way down there in the red and the price action is low. And then you could sell up here. Once the RSI got up, we got up to the 60s. So you went from 30 all the way up to the 60s. Look at all these blue bars forming in the MACD right here. That would be a time that you could let it go, right? Okay, so that's our RSI, MACD, simple moving averages, okay? Some guys use exponential moving averages. I've never used those. I've only ever used simple moving averages. The three most common simple moving averages that almost every trader looks at is the 20, the 50, and the 200. And the way I have those denoted here is the red one is the 20, the 50 is the yellow one, and then the purple one here is the 200. I also like to use the 100 moving average, which is this blue line right here, and the 400 moving average, which is this light blue one down here. And basically what those do is those act, I like to think of them as little soap bubbles. And, as price action happens, those moving averages can be little soap bubbles that can help catch the price action. And I think it's just kind of like a self-fulfilling prophecy in that everyone is looking at these, and people are programming computers to buy and sell these stocks. 90% of these trades are done by computers, and they're not even done by humans. They're done by computers that are programmed by humans. And an easy way for a human to program a computer is to look at these moving averages and either buy or sell depending on them, right? So those are the three most common. I also like the 100 and the 400, and I put them on all time frames from 30-minute all the way up to 3-month time frame. And yeah, those are some other ones. Now, some patterns that I like to pay attention to and to watch. One of the simplest ones, I think, is what's called a double bottom. And basically what that is I can look back over here. This is the chart of gold, and I'm going to zoom in on this chart right here. Let me hide the volume so it's easier to see. Okay, see the price action right here got down on gold. This was in September of 2022, and the price action got down to about 1620, 1615, shot all the way up to 1740, and then came right back down to almost the exact dollar amount. That is a double bottom. Okay, so the price action goes up and then comes back down to the same price point. Then we have what's called a triple bottom. All right, you can have a triple bottom, a quadruple bottom, a quintuple bottom. All that is that's just naming how many times it bounces off the same price point. And we can see here in gold that it had a triple bottom back in September and October of 2022. It hit right there, went up, came back down, double bottom, went up, came back down, triple bottom, and that was the lowest price that gold was at that point and has been. And I don't believe that we'll ever see 1615 gold in US dollars again. I don't think it'll get to that point. I think we've printed well beyond that. And no one would ever be crazy enough to sell it that cheaply again. There's just simply been too many dollars in existence since then. Okay, now a double bottom, there can also be a double top. And we'll use gold as an example because it's right in front of me here, and hopefully it's starting to stick out at you. But see right here in August of 2020, gold went all the way up to almost $2,100 an ounce. And then for over almost 2 years, actually, I think that was longer than 2 years, wasn't it? August of 2020 and March of 2022. No, okay, so almost 2 years, a year and what is that, 9 months, something like that. We had a massive correction here and then came right back up. And look at this, a year and a half later, it got to almost the exact same price point here that it did a year and a half prior. It hit and then corrected all the way back down, and it took an entire another year and 2 months for it to get back up to that same price point. So this would be a double top, right? So hit right there, year and a half later, hit there again, a year and 2 months later, hit there again. Now it's a triple top, and then finally on this one, we broke through on one day. I remember this day. It was a lot of fun because we finally hit a new all-time high in gold. And really, if we zoom out, you can almost say that this was kind of a double top here, although not technically because the dollar amount is up, but there was a lot of printing in between then. But anyhow, so that's a double, triple bottom. This is a double and triple top. Some other ones that we can have are ones called channels. So let's see, I'll go to oil here. So this is WTI oil. And if, pay no attention to these numbers here, that was for something else. But basically, I drew these two lines right here. And you can see that a lot of the price action has happened kind of in those two lines. And you can see that basically the way this works is the more price action that has hit and acted as support or resistance along those points kind of creates a bit of resistance or support that now the future price action has to bounce through. If if WTI oil has just kind of generally hung around $66 to $65 throughout a lot of its history over the last 20 years, then it's likely going to hang out around there again. And that's either going to act as resistance or support, depending on which side the price is on that. You can see right up here, there's kind of a little bit of a channel right there, right? We could kind of draw like a little bit of a line right there. You can see that it took for, 4 years or so, it took a while for it to kind of resolve between these kind of channel lines, or trend lines, I guess I should be calling them, right? So it took a while for it to break through that. And then when it did, boy, did it really break one way or the other, right? It broke huge to the downside, right? So these are other ones that you can use. I like the simplicity of them. And I think they are probably some of the most accurate, is simply looking at what past price action has done, drawing horizontal lines to match up with those. And, it seems pretty simple. And the reality is, it is. And I think that's one of the reasons why it works so well. Here's another one. We'll take Exxon Mobil. And you can see I was able to catch the double bottom right here. And it wasn't super scientific. We just line up the price action back here. It got down to like 108, 109. And when it saw that price action again, we bought. And that was it. You can draw along here kind of anywhere you really see like a lot of price action, right? So if we take this line, kind of line it up right around here, we got a point here, got a lot of price action there, right? Okay, what price is that? 94. Okay, we want to be looking for price action, if it ever gets back down there. It probably won't unless we have a worldwide recession, which may actually be approaching. But that's kind of what you're looking at, is you're looking for where was the price action before? How can I try to catch that price point? Where is the most price action happening, and where is it likely going to find support in the future? So that's trend lines. There's a cup and handle. So let me go back to gold here, and we'll go over a cup and handle pattern. So this is probably the best example of a cup and handle pattern that I could come up with, think of, or even know. And longtime viewers of the channel has seen me draw this many times. And basically it's a cup with a handle, and then you get a breakout. And we were talking about this pattern when all we had on the chart was something like that. So it finally came to fruition. But basically the way you read these cup and handle patterns is it has to start up. It's a continuation pattern. So it's got to be going up and then kind of correct and go the other way. So we start forming the cup. And the cup should actually resemble something that looks like a cup. You don't want it to look like kind of like this is like kind of a sharp V. That, in my mind, is not a cup and handle pattern. The cup should last a minimum of 7 weeks, and this one certainly qualifies because it goes for about 12 years. And then the handle should last at least 1 week, and this certainly qualifies because this handle lasts 3 years. So, well within the margins there. The pattern ideally should be above the 200-day moving average, and this, certainly, this just follows the 200-day moving average because that's the purple line here, if you remember. So that one doesn't really apply to this one because it's such a big and long time frame cup and handle, but it still qualifies. And the most important one, and the one that I see that I think most people might mix up, is the retracement. So when we have this cup, and we come down for the handle, what you want to make sure is that this handle doesn't retrace. Ideally, you don't want it to retrace more than 38.2%, but it should not retrace more than 50% at any time. And if it does, only very, very, very briefly. So what do I mean by that? I'll take this Fibonacci retracement tool, and this works quite well because you can program in whatever retracement you want. And suffice it to say, and to keep this simple, this orange one is the 38.2% retracement. So when you take this to this is 100%. And then how much does it retrace down here? Well, this orange one is 38.2%. This middle line right here is 50%. And this bottom one down here is 61.8. So these can work pretty nicely for finding setups. And you can see it worked pretty well here in gold. And this first retracement right here, if you were a trader, and you were to buy right here on the 38% retracement, then you could see that you had a nice little run there. And then if you did the same thing down here, if you did the same thing down here, each time you hit one of these, you had a pretty nice retracement, right? Well, in this cup and handle pattern, it kind of works the same way. You want to make sure that the handle doesn't retrace more than 38.2%. If it does, it only does so briefly before going to the upside. Now, the way we measure the targets on these and how high it can actually go is we take the bottom of the cup to the top of the cup. Ideally, if the top of the cup on the right side is higher than the left side, then it's even just a little bit more bullish. But if we take this and we take the bottom of the cup and we take the measured upside target to the right of the cup, we can see that it's about $1,000. We've got $1,029. We'll call it 1,000 to make it even. So then if we take this part right here, let me stretch this slightly so we move it up. And I take $1,000 from the top right here. So this price action on gold is around 2,100. And if I move up 1,000, then that's going to bring me to $3,100 gold. So I'm not going to, if this pattern plays out, then gold should reach a minimum of $3,100. And considering that this cup and handle pattern is a 13, 14 year pattern when taking into account the handle as well and when it broke out, I think it's going to happen and probably in short order. Okay, another pattern is a head and shoulder pattern. So we have inverse head and shoulders and we have head and shoulders patterns. Let me go to the daily here. This is one that a listener, Joe, found. And so this is an inverse head and shoulders. And so we've already drawn it here. We've got the left shoulder, the head, and the right shoulder. And if we measure this out, then we should have an upside target. What this is this is gold divided by the S&P 500. And basically it's a ratio chart. And if we take the bottom, I guess the bottom of the head, because this is an inverse. If we take that and then we go up to the neckline, you guys can see here that this shoulder, head, and then shoulder, you have a general line, something like that, right? That's kind of the neckline. And if you take from here to here, we have right there to there. That would be a ratio of 0.086, and then we'll do the same here, and we'll take 0.086 from the neckline and up 0.86, and the ratio should get to 0.57. Okay, makes sense? So that's an inverse head and shoulders pattern, and that pattern is generally bullish. Now, if we were to flip this upside down, then we would basically have a head and shoulders pattern. And let me pull one of those up. In the S&P 500 back here, that was of, when was that? That was August, I believe. June, July, August. Yeah, right here. Okay. So, not picture perfect, but it is here. And let me draw it for you if you can't see it. And it is right here. So, continuation pattern goes up. There's the head. And then we just about had the shoulder, and then it took a little bit longer to go, and it finally broke to the downside. So this head and shoulders pattern is a bearish pattern. Inverse head and shoulders pattern is a bullish pattern. And we can see this one actually worked out, right? So if we take the measurement from the top here, from the upside to the bottom, you get a difference of about $270 in the S&P 500. And so that would say that if you take from the neckline down here and go down, it had a measured move down of 270. And we got almost there, and it got down to 230. Pretty close, good enough for government work, right? So the way this head and shoulders pattern plays out is if it's when it breaks that neckline. So when we get, so you establish the neckline here, right? And this would be the day right here, September 21st, 2023, when it broke that pattern. And that's when you could put that, you could trade that put. you have a pretty good idea that it is going to break to the downside. Okay, that's all I got for my notes right now. If you guys are interested in me doing more of these, then be sure to put it. Maybe what we could do is we could do a webinar, and we could I could take live questions, and we could do a webinar and just go over a whole bunch of these patterns, or look at charts, or whatever you want. If that sounds interesting, then put it in the comments below. If you want to see how I set up this software, I'll put up a link right up here, and you can check out a video where I show you exactly what buttons to click and how to set it up and get exactly what you saw on my screen onto yours. And if you want to try out this software for free, TradingView, you can do so. And they have a sale coming up, a Black Friday sale, November 25th, where you can get 70% off. Yes, you heard that correctly. I will be extending my account then, and buying more years as I do every time, because 70% off is tough to beat. Alrighty, I hope you guys got something out of that. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.